Well, Friday's US labour market report added to the body of evidence pointing towards a soft landing for the US economy, with headline non-farm payrolls rising just a touch more than expected and unemployment surprisingly falling back to 3.7%. That allowed the dollar to remain pretty firm into the end of the week as treasuries sold off, led by the front end of the curve, though the equity market held firm once more, with stocks on Wall Street gaining ground for a sixth week in a row. A huge week awaits the financial markets this week. Deep breath. We've got decisions due from the Fed, the ECB, the BOE, the SNB, and the Norges Bank. We've also got inflation and retail sales out of the United States, a busy calendar here in the UK, and some flash global PMI figures too. And if that wasn't enough, we've also likely to have month, quarter, and year-end flows in the mix. And, of course, Friday is Quadruple Witching as well. To say the least, we've got rather a lot to discuss on the trade-off this week. So without further ado, let's get into the show. So it's going to be a jam-packed 4 or 5 days ahead as markets look forward to the final proper trading week of the year. And joining me on the penultimate trade-off of the year, as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, very good afternoon to you, mate. Are you enjoying the sort of somewhat calm before the storm this Monday afternoon?
Yeah, don't know about enjoying it, knowing what's to come, but excuse me, yeah, definite busy week coming up. It's the holiday season coming as well, so they're going to make us work double hard before we go into that. And yeah, it's a very exciting week to look forward to, and I'm busting at the seams for it.
Most definitely, and the show is busting at the seams as well. So in the interests of time, we best crack on right away with Topical Thunder. So I want to kickstart things this week with just a very quick look back at last week before we get on to the bonanza of policy decisions and data releases and God knows what else that's going on this week. And the best place to start in terms of last week is with the November US jobs report that we had out on Friday. Another pretty solid report, in all honesty, for the US labour market. Keeps that soft landing consensus on track and again delays those expectations of a broader labour market slowdown, which I think, Ryan, we've probably been talking about and expecting for much of 2023. To run through the numbers, headline non-farm payrolls rose by 199,000 on the month, just 9 above my own guesstimate. So that was well worth the wait for you all. I know everyone was waiting with bated breath for that one. Although it's important to caveat that the 199K NFP print was obviously spurred on by 30-odd thousand auto workers coming back off strike. So a little bit of a pinch of salt required with that one. But I think the real positive for me was the household survey. You look at the unemployment rate down 0.2% to 3.7%, underemployment falling by the same magnitude, and that pleasingly came as participation actually rose. More people coming back into the labour force, with participation now back at the 62.8% cycle highs that we saw over the summer. So a pretty decent report all told, but I think actually in my view, and I'm keen to get your thoughts on this, Ryan, I would argue that the Fed, and we'll talk about that a little bit more in a second, of course, have almost an asymmetric reaction function at this point. They've obviously got a dual mandate. They want maximum employment and price stability. But I think if you look at both sides of that mandate and what is likely to push them towards or away from a cut, I think that strong jobs data is much less likely to push them away from a cut than cooler inflation data that we get obviously on Tuesday is likely to push them towards it. And I think actually that is why markets, by and large, we had a little bit of a knee-jerk move over the print, of course, but by and large pretty much took that payrolls number in their stride on Friday.
Yeah, very much so. And it was a strong number. It was soft landing figures. I mean, you know, auto strikes aside, whatever it is, we never really saw the numbers weaken when they were on strike. So throwing them back in, it's made no real difference. The number was there or thereabouts, even if you take off that 30K odd. And obviously, yeah, strong unemployment rate with that participation rate going up. So no problems in the jobs market there. We've had a couple of flags, obviously, from the jobless claims, the continuing claims numbers just were edging up, but they came down again last week. And then we had that JOLTS number as well. So there are some small elements of weakness, but the main number, the NFP, says nothing to see here, move along. And you're right, that's helped take some of the heat out of what we've seen with the Fed expectations. We also had that Michigan number as well, which was a nice rise in all the metrics, all the components, and further falls in inflation expectations, which had been running a little bit hot the prior 2 months, and that completely washed out. So again, more soft landing numbers for the Fed, more numbers they want to see going the right way. The consumer not collapsing and doing well, and inflation expectations coming down. So it's all coming up roses for the Fed at the moment.
Well, so it would seem. I'm glad you mentioned the Michigan sentiment survey. I'm a little bit sceptical of it because it does have a slightly too close for comfort correlation with equities. When equities go up, consumer sentiment goes up according to their index. So, it is nonetheless good news on the inflation expectation side. But I think that headline gauge requires a little bit of a pinch of salt. But as we've both alluded to, big week coming up this week with the Fed, the ECB, the BOE, and you have drawn the proverbial short straw to tell us all about it, mate.
Yeah, so thank you very much for that. Well, we're going to do a bit of ping pong for this one because obviously we've got a ton of central banks. So we're going to be looking at the main three. I'm going to start with the ECB, and we will go through all three of these banks, looking at the current scorecard and the focal points and where we are with hikes. Are they on the table, off the table, and cuts? So looking at the ECB first, quick rundown. CPI is at 2.4%. That surprise move well into 2% handle. The core still proving a bit sticky at 3.6%. Last GDP numbers that we got, quarter on quarter, down 0.1%, year on year flat. So as far as the growth stakes are concerned, very low, very anemic. Nothing to write home about there. Nothing excitable there. So for the ECB, I think the core message that we're going to get from them is to keep the higher for longer message in play, to reiterate the job's not yet done. That's going to be needed to keep with all this expectation for cuts flying around the market. The Lagarde is not going to want to let all these hikes unwind, the tightening that they produce unwind artificially, those financial conditions that we're always speaking about. I think really the only conversation that we're going to get that might be market moving, I'm not expecting any big fireworks, is obviously what they're going to do with the PEP reinvestments. Are they going to announce, is Lagarde going to say, we've started discussions on ending those with a view to doing something in the new year? Or are they going to turn around with some action and say, yep, definitively from next meeting or even from this meeting, we're going to stop reinvestment, and then we'll get something that might be taken a little bit hawkishly by markets. As for inflation, I think the big risk for the ECB at the moment with that 2.4% print is that they overshoot on the other way, on the other side with inflation. Let's say inflation comes down to 2%, goes through 2%, and maybe in 3-4 months' time, we're looking at inflation 1.2, 1.3, something like that. How's the market going to react to that? How's the ECB going to react to that overshoot? We've seen cut predictions coming down slightly. They were running around 150 basis points last week, come all the way down to the end of the week around about 125 basis points, which some might seem a little over-exuberant on the dovish side. I'm thinking it's all about the message for the ECB and all about what they may do with the PEP reinvestments.
I would tend to agree with that. And I think PEP is something that they will discuss, but I don't think we're going to get any firm timing or decisions on that probably until January. I like how we're doing this in reverse order, mate, or in reverse chronological order. I'm just going to touch very quickly on the BOE before we bat it back to your good self for the FOMC. I think the BOE is probably the easiest one to call, actually, out of the major central bank decisions that we've got coming up this week. Compared to what we see in the US or the Eurozone or elsewhere, inflation remains far too high here in the UK. The headline number has come back under 5%. The core number is still at around 6%, and services inflation is running nearer to 7%. So all of that is going to be very concerning for policymakers down the road at the old Labour lady. And of course, that those inflationary pressures are becoming more sticky and entrenched within the economy, particularly as earnings growth remains close to 8%, which is clearly incompatible with a return to the 2% target. Growth is pretty much non-existent here still in the UK, but I think actually we've had relatively little since the last MPC meeting at the start of November in terms of data or in terms of other developments to really change anything the BOE are going to do. And I think, again, we're going to see them say that they repeat this higher for longer guidance. Policy needs to remain, as they're calling it, sufficiently restrictive for sufficiently long. They'll throw in a line that they'll hike again if they see further signs of inflation persistence. I guess the only really potentially interesting thing is the vote split. It was 6-3 in favour of a hold last time around. Mann, Haskell and Green voting for a 25 basis point hike. Maybe one or two of those dissenters will come back into the unchanged camp, just as those lagged policy effects continue to feed through into the economy. But I think the BOE is, and I hope this isn't famous last words, I think the BOE is going to be a relatively straightforward final decision of the year for the MPC, which perhaps you can't say about the Fed.
No, you can't. But just quickly on the BOE, don't forget we've got wages data coming out. Well, you would have had them by the time we print this. So that might be a little bit of input for the Bank of England. If those wages are still hot, that will feature likely in their language and probably keep them on the hawkish side over there.
Very good show.
But yeah, over to the Fed, the big one. This is the one we're all waiting for. And just to run through the scores on the doors. CPI, we saw at 3.2% at the last read. Core holding steady at 4%. We obviously got that bumper 5.2% GDP number, which is the quarter-on-quarter annualised number. The annual GDP rate is currently at 3%, so that's still pretty healthy. Now, Powell has already hinted that his message would potentially be the same. He did that back on the 1st of December, that college appearance, saying the job's not done, policy still not yet sufficiently restrictive, but we're not in a rush now, and we're still data dependent. But the fact was the market ignored all that, and it went on trading, how long or when's the next cut going to come, and how many cuts are there going to be, and when is it going to start. So it completely ignored that message. And I think what we're pricing now is around about 125 basis points of cuts, which is down from, we were pricing 125 basis points of cuts. That's since been moved down to about 110 basis points. This is for 2024. We also got that piece over the weekend from our mate Timmy Leaks at the Wall Street Journal, stating that the Fed would not be entertaining talk of cuts as well. Not be entertaining talk of cuts for maybe several months. Then we also had that strong data from the NFP and the Michigan. So it's put a little bit of caused a little bit of an unwind in those cut calls from the market, hence why we're now not seeing as much predicted for next year. The latest CPI is tomorrow, and that is going to be huge and a big volatile mover for rate expectations. We're expecting the headline to drop a pip, and we're expecting the core to stay unchanged. Now, the Fed will obviously have that data on day one of their two-day deliberation. So what we need to know after that is, will Powell push back on the strong rate cut talk, or will he let the market loosen financial conditions further just to help with that soft landing? And then, obviously, we have to find out what the dots are going to say about those cuts. So I'm going to ping it back over to you, mate, and I'm going to ask what you think of is coming from the Fed and Powell.
Well, I think we're all going to go dotty over it, whatever happens, aren't we? Sorry, that was really bad. I had to, sorry. I don't think the Fed are going to do too much different. I think they will probably tweak their language, and I'm going to steal this wording from Wells Fargo because they put it better than I can, where they changed the statement to reflect that cuts are that hikes, not cuts, hikes. Hikes are still possible, but they are less probable than they were, at the November meeting or the September meeting before that. You see, I told you they could put it better than I can, garbling their quote. I think the dots are likely to, this year's median dot will come down 25 basis points because they haven't delivered that extra hike. I think you're going to see the median dot for 2024 come down by 25 basis points to reflect that they will still cut 50 next year, according to the dots. But other than that, I don't think we're going to see too much in the way of material changes. Maybe a tighter dispersion, some of the uncertainty around where rates may go. The dots will be a lot closer to that median. But I do think that the Fed, like the ECB, like the BOE, like everyone else, are not going to want to declare victory too prematurely, even though inflation is close to getting back to target. We're not quite there yet. And I think your point around financial conditions is an important one, because policymakers are going to want to see financial conditions remain relatively tight until 2% inflation is assured, and arguably until we've actually achieved that for a good couple of months.
Yeah, very much. I agree with that. But as I say, I think I've got at the back of my mind that even if they let financial conditions ease a little bit, maybe they can avoid what I was speaking about the ECB, that they then go and overshoot on inflation on the other side. So maybe it's can be seen as artificially taking their foot off the gas pedal a little bit just to encourage that soft landing. But I think you're probably right. They need to keep the message in there that the job's not done, and thus keep those financial conditions tight.
Yes, and I'm sure that will be question 1 or 2 of the press conference in any case. So after that, we can turn it off and put the Champions League on, which is likely to be far more interesting. Right, I want to just quickly cover off everything else that is happening this week very, very quickly, because it is a busy week ahead. Away from all the fun and games of those central banks, a busy data docket does await. And it's busy because this is the last proper week of 2023. Most institutional traders will be disappearing for the festive season after this week, if they haven't already. So we're effectively getting 3 weeks worth of data and risk events in the space of 4 days, which is brilliant for all of us, I'm sure. Going through it day by day, we've covered a few of these already, so I won't dwell on them for too long. But Tuesday, by the time you watch this, we'll have had the UK jobs data out. Ignore the unemployment rate, because the data there is horrifically skewed. The ONS working on a new methodology for that still. Earnings a key driver of BOE policy, of course. We've also got some sentiment surveys out of Germany, the ZEW index, and US inflation, as Ryan mentioned. Headline CPI set to dip slightly to 3.1 from 3.2% prior. The core number remaining at 4%. And I think actually, of all the things coming up this week, that is the one that you really need to be at your desk for. And that's the one that could really kickstart a pretty significant cross-asset reaction. Wednesday, obviously, the FOMC decision. We've also got GDP out of the UK, which is a little bit stale, but the economy set to have contracted a touch in October. We've also got PPI figures out of the United States, which should show more disinflation coming down the pipeline. Thursday, we've got all of those central bank decisions, plus jobs out of Australia. We've also got jobless claims out of the United States. That will be interesting, particularly the continuing claims number, whether that chimes with the unemployment rate falling, as it did, as we had in the NFP print on Friday, or whether that continues to tick higher and tell a little bit of a different story. We've also got the November US retail sales report. And of course, that will cover the Black Friday period and the early part of holiday spending. We're expecting a modest fall in sales of around 0.1% on a monthly basis. Moving into Friday, I'm running out of breath here. We've got a whole host of economic data out of China, which Ryan is going to get onto in a second. We've also got flash PMIs for the Eurozone, the UK, the United States, and pretty much everywhere else. And as if that isn't enough, Friday is also quadruple witching. So equity index futures and options and single stock futures and options will all be rolling off on Friday afternoon. There's a lot of other futures rolls and option expiries going on then as well, which are worth paying more attention to than usual, I would argue, given the increase in volume in thin liquidity markets could have a more outsized impact than we would otherwise expect. And we also, as we move towards the end of this week, we're likely to get some month, quarter, year-end flows, rebalancing, book closing, profit repatriation, all of that good stuff going on as well. So
Mm.
while I get my breath back, Ryan, what's the one event amid all that stands out to you, mate?
I don't know, mate. Looking at all that, I think I'm going to jump in a cab and run to the airport and go disappear for the next 2 weeks. But it's all that save the best till last. I think just to pick one item out of that, it's going to be US retail sales, and not so much for what it does in itself, but that's going to be the first big data point after the FOMC. So we'll know what the FOMC's thinking is for the end of this year, for the recent data, going into next year, more importantly, where they see the path of hikes, if they're coming again, or even cuts. So that big piece of data will be the first to test that rhetoric from the day before. So I think that could be pretty important just for what the Fed have said. As for the rest, you can take a dart, shut your eyes, and throw it at the board and to see what's coming from that. But yeah, I think we've got the PMIs on Friday. I don't think anyone's going to be that bothered about them. The pubs will be open, and everyone will be looking forward to the holidays, I think.
I was going to say, I'm not sure anyone's going to be here by Friday, to be quite honest with you.
You will be.
Well, I will be, sadly, manning the fort. Someone has to. Anyway, it's also a big week in China, isn't it, mate?
Yeah, big week in China, and a few more trees shot up in the woods that China isn't out of yet, because over the weekend we had CPI numbers coming in much worse than expected. Year-on-year CPI coming in at minus 0.5%. Versus minus 0.2% in the prior reading. And I look back over the last 6 months, they've only had one 0.1 positive month. That's been it in the last 6 months. They've had 2 flat readings, 2 months of flat readings, 0%, and 3 negative numbers. 2 of those have come in the last 2 months. So that suggests there's a bit of a problem going on in China with deflation, we can probably call it now. But there has been some bright spots there still. Retail sales are looking pretty good, but that's been aided by fiscal measures in China. GDP remains positive, although much weaker than Q2 on an annualised basis. The PMIs have been mixed, and surprisingly, which I know you're going to find surprising, the official PMIs have come in lower than the private PMIs. I know you don't like Chinese data, old chestnut. Sorry, mate.
Someone's going to get in a lot of trouble for that.
Who's going to get? Oh, yeah, someone probably getting in a lot of trouble for that. But
someone's being carted off somewhere when they realise that.
Yeah, well, it won't be you, so don't worry about it. But those inflation numbers will be the big worry for officials over there now, and that could trigger the PBOC and officials into perhaps another RRR cut, as well as cutting their other rates too. Now, given also that exports remain well into the negative, could that prompt a rethink of relations with the West, particularly America, if China feels that this decoupling by other countries is now materially impacting trade? Because as much as they are pushing to grow their domestic economy, they can't afford to lose too much globally either. So the Chinese situation is yet another big one to watch in early in 2024. And I'd like your thoughts on China as well, mate.
Oh, my thoughts on China. I just revealed my thoughts on China. It is an interesting one to watch. China is always an interesting one to watch. I think the problem with China is, to put it diplomatically, it's very difficult to watch because it's tough to know what is actually true and what isn't true in terms of the information and the data that we're getting. What I would say is it's worrying that the amount of stimulus that has been thrown at the economy appears to have had basically no impact. You're still talking about very, very anemic growth. And now we're obviously talking about pretty much outright deflation as well. So I think that is concerning. I think that speaks to a broader need in the Chinese economy to transition to more of a services-driven economy, as we see in the quote-unquote Western world, rather than one where the government is kind of underpinning growth with spending and a bit of statistical manipulation thrown in for good measure. But I think that is a theme that is not just going to be for 2024, but actually probably for the next, maybe even for the rest of this decade. It's going to be a long transition. It's going to be a bumpy economic transition. And I think the thing to watch is those spillover effects. I mean, you look at the Eurozone, for example, you look at Germany. One of the big reasons why Germany's economy is going to be doing so dismally at the moment is because demand from China has pretty much dried up. And it's the same when you look at the luxury goods sector in Europe as well. So I think the bigger concern I have is not necessarily how does China manage that transition itself, but it's what are the impacts of that on other economies that really can't be dealing with any sort of economic shock at this point.
Yeah, that's a very fair point. You always got to look at both sides of the trade, and as much as it's costing China, it could be costing the West as well. But I think we all know that China is supposedly the global growth engine, and if they're spluttering, then that doesn't bode well for the rest of them.
No, it certainly doesn't. Well, on that optimistic note, why don't we look at some charts? Right, I want to look at gold to kick things off this week. Obviously, we spoke about the yellow metal in last week's show. We were recording, in fact, just after the new all-time highs were printed around $2,135, $40 an ounce in the cash market. Obviously, futures prices will vary depending on the contract that you're looking at. But nonetheless, what won't vary is the direction of travel that we've seen since then. The yellow metal has lost quite a lot of its shine since those record highs that we saw last week. Sellers really wrestling back control of things, and actually in early trade this morning, we've seen gold break back below $2,000 an ounce. So not only have we rejected quite firmly, that's a failed break now of the, well, I guess quadruple top, if you really want to call it that, at 2,075. We've also, from a fundamental point of view, got a handful of factors that are starting to work against gold. The dollar rallying back a little bit last week. 2-year treasuries selling off by around 20 basis points as well certainly won't have helped. And it looks like the path of least resistance is going to lead us lower for now. That break clearly failing above 2,075. So I think the bears will now be looking for that bunch of moving averages, which come in between $1,940 and $1,960 an ounce. And we will see, of course, how price reacts when we get to that level. If we hold them, then perhaps that is going to mark a little bit of a short-term floor and support point for gold. But it does look like we're going to get a test of that region in the relatively near future. What are your thoughts on this rather ugly chart, to be quite frank?
Yeah, of course, it's not going to win any awards, this one, is it? It's definitely no Banksy. But yeah, we've had the break back under that, we can call it a quadruple top now. And what happened was straight after that, we found resistance there again. So yeah, it's back to being a solid level. Whatever happened with the spike above, that's by the by now. We know that the levels are level once again. The fact that it's pulled back as far isn't really a surprise, given the volatility of the move higher. We're back under 2,000 as we're doing this show. I wouldn't be surprised if we get a move maybe down to sort of low 1900s, and to put this, bang in the middle of that range we've seen, over the last couple of months, those lows around 1800. I wouldn't be surprised at that at all. A lot of people are making the conclusions with what's happening in inflation and, is gold an inflation hedge anymore and blah, 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 blah. I don't care. I just trade the levels. And, while we're going to be holding below 2000, probably 2010 now is where you want to look. That was the prior break point before we went on the run to the highs. So keep an eye on that. If we hold that on a retest, then it's going to give shorts more ammo to get in. And like you say, down towards those moving averages, 1960s, that's been an area, 1930s under that, and then into the big fair at 1900. Go with the flow, trade the levels is all I can say about that one.
Absolutely, yes. Gold is not an inflation hedge, and that is a hill that I am more than willing to die on, but this show is already going to be far too long, so we won't go into that now. What about even more on China? We can't get enough this week.
You can't get enough China. Well, I haven't talked about it for so long, so you're getting double bubble this week, mate. But yeah, the authorities over there are still fighting fires in the yuan. Since the big move down from the 730s, they've continued to step in to strengthen CNY. Even last week, they were selling dollars versus their own currency at least twice. Now, numbers like the CPI data we spoke about, we got over the weekend, won't help their cause at all. And it could mean we might have found a bottom for this recent move. Today, we've seen dollar yuan bid up on the CPI data, as well as some of that unwind from the Fed rate cut expectations. Now, the drop from the 730s was all about the market view that the worst was over for China. And a lot of it was led from the US side and what happened with the dollar and those dovish expectations for the Fed monetary policy. So when trading this pair, you need to know what is influencing it at any given time. This time, the yuan weakness is a bit more about China weakness than it was than what's going on in the US. That makes it a slightly different trade altogether. So unless China really does come out of the woods next year, I'm expecting potentially some further upside pressure to materialise and maybe a wander back towards those 730 highs. If their fortunes do improve, then I'd expect us to be heading down through the recent support around that 711 area and on our way to the big figure. Now, I'm still short this pair, been short for quite a while now. I have been getting a bit twitchy that we were going to see a break up purely because we didn't get a breakdown through that 711 area. Now I'm going to be watching it very carefully for the over the Fed for the dollar side and what happens in China for the rest of the year and potential cutting of rates.
No, absolutely. It was worth the wait, mate. It's been a while since we heard you talk about dollar China. As you say, it was plenty to cover off. And I couldn't really agree more with you, to be honest with you. I actually, for once, I don't have anything more to add. So let's move on.
It's taken all year to get to that point.
I know. I don't know what's caused that, but for once I am dumbfounded and speechless. Right, let's have a look at the euro. It was another pretty dismal week for the common currency last week, actually back-to-back weekly losses, I think for the first time since the middle of summer, although do not quote me on that one, because I've only eyeballed that on a chart, and that may or may not be accurate. But the dollar rebounding just a touch last week, and we've now come back below the 200-day moving average. On a closing basis in euro dollar for the first time in around about a month. And we're sat right on the 100-day moving average now. In fact, just cracking below it as trade gets underway this week. So certainly the 110 highs that we saw a few weeks ago now seem very, very lofty indeed. It would look like, and we actually mentioned this a few weeks ago, that there are selective dollar longs are looking quite attractive in the market at the moment. I would say here is certainly one of them. If we get a close below this 107.65 region, then you'd be looking for the 107 figure relatively quickly, maybe a very, very small smash and grab trade into the Fed and the ECB, obviously, a little bit later on this week. But actually, if you bring up a chart of cable, the charts there are looking very, very similar indeed. Cable, we rejected 127.20, and then we've come back down into the 105. Into the 125, with the euro, we've rejected 110 and then come back into the mid 107s. And I think here it is a wait and see. If we get a closing break back below that 100-day moving average, then if you are short, you may look to add to that position, or if you're not, then that may entice some more bears to come in and enter the market. And if I remember rightly, Ryan, I think this may have been my play of the day a couple of weeks ago, which for once seems to actually be playing out as we expected it to.
Yeah, good call again, mate. You're knocking them out of the park recently. You are correct. While you were waffling on, I did check to see whether we had 2 weekly negative candles. And just want to make sure. And we have. You are correct on that as well, though it's nothing close to the. I think it was 9 that we got over the summer and the rest of the year when it completely fell out of bed. But this one. A bit of an important move. We had got the 50% fib at 107.33, and give or take a few pips, we held it last week and bounced from there. So for now, the trend for me isn't broken. That was coming in, from October. Those lows around about the 104.5. So the trend, as I say, isn't broken yet, unless we get under that fib and then take out the 61.8, which will be the line in the sand. It keeps the momentum going. So, yeah, I think it is a bit of a coin flip here. We could see a bit of volatility, obviously, between the US side and the Fed and the ECB. I think where we close the week in this one is going to be key to where we continue into the new year. So if we're holding above that 50 fib and maybe a bit higher, maybe 108, then I'll put a little bit more of a bullish slant on things to end the year. If we're below that, maybe down to the low 107s, and 107 is a big old level. That might put a more bearish complexion on this one. But yeah, I think where it finishes the week is going to be the most important thing.
Very much agree. 2:39 on Monday afternoon. Spot currently trades 107.50. I'd put decent odds on us probably ending the week at 107.50. Such is how these monster weeks tend to go, where everything just ends up cancelling each other out. But one place where we have seen some volatility, perhaps the only place where we've seen some vol to start the week, is in the Japanese yen.
Well, Christmas is all about surprises, and yeah, the Bank of Japan decided to drop us all a nice present last week. First, we had Deputy Governor Himino saying that the economy is likely resilient enough to weather stress from a transition to higher rates. And then the icing on the cake came from UEDA, telling us that they may raise more than just negative rates, and that they haven't decided yet, and that they also haven't decided how much to raise rates by when they end negative rate policy. So yen pairs fell out of bed on that, and dollar yen had its biggest weekly trading range since the 19th December last year, and most of that was done on Thursday. Now, we've had a complete reversal since, as officials and sources have issued statements about UEDA's comments being misinterpreted and warnings over consumption being a risk to tightening. And so we've seen yen pairs have bounced back massively. All of that really has given us a taste of the reaction we're going to get if and when the Bank of Japan do finally turn. Now, I've had an itch to get the short this pair for the last few weeks, but I've always been waiting for a better level, and I thought I missed the boat with these recent moves. But now they're reversing on this BOJ reverse and the reducing Fed cut expectations from the Fed. I might be closing in on some of the levels that I want to get to start that short trade. It's possible we get a further rally back on the back of the Fed and the Bank of Japan next week, who are unlikely to announce anything at that meeting. So if I see a move back to anywhere 147, 148 or better, I'm going to have to start thinking about getting into some shorts. But I will have one eye on the carry if that's before the Christmas break, because I don't want to be sitting in a trade that's going to be costing me money and doing nothing for that holiday period. As for the downside, we've had that brief blowout through the 38.2 fib of the whole 2023 rally and down to that 200 daily moving average. But I suspect we might see that area a bit more sticky on a slower move back there like we did on Friday. So for now, it's all about what happens at the Fed and the Bank of Japan. I think we are likely to see this moving higher on a more hawkish Fed and an unchanged Bank of Japan. Then I'm going to be thinking about getting into those shorts.
Absolutely. I think your point about carry is an incredibly good one, particularly at this time of year. I do wonder whether jumping on short dollar yen is something that folk may wait until early 2024 to do now, rather than looking to do that in the dying embers of 2023. But you're right. I think this speaks to, well, firstly, as you've rightly put in the little bottom corner there, a taste of what will happen when the BOJ do eventually come out of their ultra easy policy. And secondly, I think it also just shows us that every man and his dog is trying to front run when they are actually going to do that. Because if you read the comments from Himino, if you read the comments from UEDA, they weren't exactly hawkish. They weren't exactly explicit saying, you know, this is what we're going to do. It was all very caveated. It was all sort of scenario planning. And ultimately, you know, we all know the BOJ are going to tighten at some point. So if they weren't doing this sort of scenario planning for the end of negative rates, you'd actually arguably be more concerned about what on earth they're supposed to be doing. But yeah, I think short dollar yen is is certainly becoming a consensus view as we move into next year, which maybe in itself is a little bit worrying if that position does end up getting a little bit crowded. But we shall wait and see, of course.
Yeah, definitely. And I'm going to take the other side of that trade over whether the Bank of Japan officials were hawkish, because for me, it was just another little set of comments that is preparing the market, giving a bit more. Everyone was thinking previously it's just going to be the negative rate going to zero. Now they've opened the door to say we might not stop at zero and we might look at other rates as well. It's just that confirmation that's just a couple of steps more than what we had previously, and that's I think why the market got overly hawkish about it.
Indeed. Whoever knew we could get so excited about a 10 basis point hike that may or may not come in about 9 months' time? What a wonderful beast financial markets are at times. Right, let's get on to our plays of the day. Well, I'm sure I'm going to get moaned at here, but if Ryan can mention the CNH, I can mention the S&P 500. I'm going to keep this very short and sweet this week. We've had 6 straight weeks of gains in the S&P 500. I think what we're seeing here is a bit of a momentum move and a even if I can talk, a classic case of strength breeding further strength. The market continuing to take out key levels to the upside. We trade north of 4,600 this morning. 4,630, the highs that we saw over the summer, are the first target to the upside, and then maybe even the 4,700 handle. Obviously, seasonality remains favorable. I still find it pretty tough to bet against US equities at this point, but it's worth noting that we're also seeing stocks gain elsewhere as well. The DAX over in Germany, for example, hitting an all-time high last week and giving us another brilliant bit of evidence as to why the stock market is not the economy. I do think if we were to get any dips over the Fed or the inflation number or any of the other big risk events that we've got coming out this week, I think that as long as we're above about 4,500, they are dips that I would be looking to buy into. So long and strong, the S&P 500 this week. Ryan, we're looking at euro sterling by the looks of it.
Yeah, very much so. It's been quite hard to pick a trade this week that doesn't involve a central bank. So what I've done with picking this one, I think it's perhaps the cleanest trade for trading the outcomes between the Bank of England and the ECB. Now, as I expect the Bank of England to be a bit more hawkish than the others, I think that will favour the short side for this pair. So with that in mind, I'll be looking at shorts on any decent rally before these two meetings. 8600, 8610 is one area to watch. Conversely, trading a break of this current solid 8550 support that's in situ might be the other trade, even if it happens before those meetings. Now, I should add, I'm still long this pair from 85, so both these trades might be defined what happens if we get back down to that big 85, 8480 zone. Should the short get triggered, that's the level I would be looking at closely for whether I close the short and add back into my longs, or fold the long and keep the short and add to the short indeed. But I think just for a pure B central bank play between the two, I favour the pound over the euro, so downside and shorts for euro sterling.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forexflow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. And he now has a hell of a lot of editing to do, and will be reminded that next week he needs to turn his phone off before we hit record. Hopefully the show has been useful, and we've given you a bit of a steer as to some of the big event risk coming up this week. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and we will be back for one final show of 2023 this time next week to try and make sense of what is likely to be a very, very busy few days for the financial markets. Thank you very much as always for watching, and goodbye for now.